very happy to be here. Like Todd mentioned, I lead content strategy for global research. What does that mean exactly? I'm trained as an economist, and now I sit bird's eye view in JP Morgan's global research department. We have 1,000 analysts covering all asset classes, all companies, all across the globe. And it's mine and my team's job to effectively watch what trends, variables, factors are percolating up, what are clients interested in, and then we highlight and light up those themes for our clients. Because like yourselves, you're senior leaders and you're global, you don't always need to know about the minutiae of certain things. It's always maybe at times useful to know what's going on, big picture, what's coming down the pipeline. So with that, we are going to talk about a few things. We're going to talk about the macro and monetary outlook. What do we see for the global economy through year end and into 2024? And then we put together three, I want to call them special topics for the group. So we're going to talk about generative AI, LLM, large language models, what we're seeing there, the hype and the opportunity. We're going to talk about data, opportunities, and what's happened with data analysis within the last 5 to 7 years. And then we're going to touch on ESG, but I'm going to make sure we leave time for questions, because I always actually learn a lot from client questions, and I think the group in the room normally does, so we're going to leave 10 minutes for that. Okay? So actually, let's start with the globe. What is actually going on with the economy? Because there's a lot, and it's been swinging around. I would say post-pandemic, right, we had a demand shock, a supply shock, a demand shock, and now we're normalizing. So that's not the most eloquent theme anyone's ever presented, but we're really just normalizing with respect to growth, with respect to inflation, and with respect to monetary policy. So the global economy is growing at trend, which is good. We don't expect a recession in the next 12 months, but we will hit a recession eventually, and I'm going to tell you what the chain of reactions we think we're going to get there. So even if the global economy is growing at trend, there's a lot of divergences happening under the surface, and I'm going to just talk about two. From a sector perspective, services, which have been running really hot, a lot of demand for services globally, is starting to come down off the peak. It's not declining, it's not falling into recessionary territory, it's just moderating and normalizing after a lot of services that were pent up and we all wanted after the pandemic. Simultaneously, demand for goods, the manufacturing, we've been in a slight manufacturing recession. The tech cycle within Asia, not just including China, but within Asia more broadly, had been contracting. We now expect that to rebound. So you have services falling off a little bit, rebound in global manufacturing and in goods, and that's evening out to just trend. If you then look regionally, there's a lot happening, and I'm going to admit where there's a bit of a question mark, and I'm going to admit where there's some debates. So globally, the US is above trend. And I'm going to be honest, it's defying expectations and it's defying odds. Q3 GDP was 3.5%. Trend growth in the US is about 1.9, is what most economists think. That's a huge gap. We're running 1.5% hot on where we think trend should be. And it is defying expectations if you think that over the last year, monetary policy has gotten unbelievably tight, and yet the US economy keeps persisting. So if you listen to Michael Feroli, our chief US economist, and the economics team, they're at times making a point that you've seen a contraction in interest rate sensitive sectors, such as housing, but, and this is a pretty big but, a lot of the economy is not as sensitive to interest rates as it was. It doesn't have as much oomph and impact on the economy as it did. And we look at the consumer, we look at the household balance sheet, and we look at corporate resilience, and you can put a check mark effectively on all three of those factors. The US economy is also 87% domestic, so it can run itself on its own machine. Interestingly, Bruce Kasman, who's our head of global economics, the team just did analysis to show intuitively, something all of you all know, practitioners and operating in the real world. If the US is growing, it does have very positive spillover effects, and you tend to not get a global recession when the US is growing. And yet the US is domestic, so it's kind of interesting. The spillovers from the US economy into global are through financial channels and financial markets, and we just don't see the US falling into recession this year. And frankly, next year, we are now of the view that you do get that soft landing, that the labor market slows, inflation starts to slow to a pace that everyone's comfortable with, and you just glide. I'm going to go a little bit more into the US on the next slide because I think it's worthy of that. But talking about the euro area, Europe has also defied odds. We were of the view, full disclosure, Greg Fusey, our chief European economist, that Europe was going to fall into a recession after the Russia-Ukraine war started. And once again, Europe, obviously not gangbuster growth, but it's defied those expectations. It's been resilient, growth has stayed, and that has been driven by the consumer for the most part. What about Europe going forward? So if you look at this orange line on the chart, Europe is definitely below its trend. It's growing below trend, but it's not negative. Or we haven't seen a technical recession or recession. With Europe, where we think the rubber hits the road is with energy prices, but not the Europe tipping off the cliff and tipping off into recession. We just now look at Europe, and our head of commodity strategy, Natasha Kneva, her view and the economist's view is Europe does not have a viable business model when it comes to production, given the cost of energy. Which, I think that's obviously something that's going to take years and regulation to figure out, but we're concerned about it now. And to provide a little bit more context and detail, even though gas, European gas, the TTF price, it isn't massively high the way it was last year, the year before, it's come down tremendously, it's still 3 times higher than it was in 2019. And when we talk to clients, companies that we cover within Europe, industrial production, things happening in Germany, Southern Europe, it's not economical for them to be using energy for a lot of these production processes. So that's not showing up per se in terms of really negative growth numbers yet, but we're concerned perhaps about some of the viability of European growth from a production perspective going forward, hence the below trend. The consumer, though, within the US and the consumer within Europe have both been strong. Many of you have probably heard of that excess savings argument. Excess savings, right, pandemic-related relief, fiscal stimulus, that's still present, but we're starting to look at it more from a distribution perspective. Who has those savings? Who has them left? And who's willing to spend them? Right? So the story a year ago was, don't worry, the consumer has savings, they're spending them, they've got them. That's not a support anymore, in our view. That's not the support for the economy that's sustainable, and that's not a support for companies we cover, for equity earnings. So something to keep in mind, because that's a big, I would say, bolster and support that we are seeing now start to roll off. And then China. So a lot going on in China, obviously. I know everyone's very aware of that. Chinese growth is being transitioned from property, infrastructure, real estate into consumer, domestic driven. And it would be very expected that that would be bumpy and difficult. We see growth in China running at about 4% this year and next year. Yet the Chinese government, they do release their estimates to the market, and normally, as we know, they like to hit those estimates each and every time. They're still saying Chinese growth can average around 5%. We don't see that. It's not just that growth is slowing down. There's pockets of instability that we've been tracking closely. One is property. Many of us are aware of that. The other is refinancing and restructuring of debt, both on government balance sheet and off government balance sheet. And that can be done. We're hearing about it being done. It's in process, but it doesn't make it any easier. And then the third factor impacting China, which I'm going to say this, but I say it knowing that it sounds a little woo-woo perhaps, or fluffy, but that's confidence and sentiment. And I'm always amazed when I talk to Haibin Zhu and Wendy Liu. These are our Asia-based analysts, research analysts. They cover the economy and the equity market. They've told us you actually cannot underestimate how depressed confidence and sentiment in China is, and how that is rippling over into spending decisions, saving decisions, entrepreneurial decisions, and the like. And I find that very, very interesting because we talk about it, it's kind of nebulous, what does it mean? Are you confident, are you not confident? They've said the number one thing, even more than, perhaps more stimulus, which I'll talk about in a moment, you need Chinese citizens, Chinese business and officials to feel confident and to feel that sentiment is up, and business confidence is just unbelievably depressed there right now. Various reasons for that, but part of it did have to do with activity, lack of activity we saw after pandemic when the rest of the world was opening and China was not. So around stimulus in China, because it's kind of interesting, we hear this from the grounds up from researchers who cover equities and credit single name, is you're seeing the rise of industrial policy. And I don't know if it has such a negative connotation as perhaps it did in the past. For those who are maybe not as aware, industrial policy is just the idea that the government comes in, decides, puts money. In the truest sense, industrial policy, which is a trend that's been on the rise, but I would say it's been very prevalent in China for a lot longer, it is technically about the idea of government, educational institutions,